Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to the very first episode of 2024 of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, we're titling this one, it's episode 66. Titling this one, Welcome to 2024, and this one is sponsored by Y Charts. Sonu, are you working on your tan? Where are you right now? Where in the world? Where in the world is Sonu? Every time we talk to you, you feel like you're somewhere fun. More fun than where I am. Yeah.
Florida, Naples, Florida. Not Naples,
Okay.
Italy, but
Yeah.
here for the sunshine. But, one thing I've learned that Florida can get cold too. It's about, it gets in the 50s, 55 degrees Celsius, Fahrenheit in the morning. And so that's cold. And I was half expecting it to be like 75-degree weather throughout. Not quite, but still, we've had plenty of time to hit the pool, hit the beach, and it's been nice, Ryan. Happy New Year to you.
Yeah, no, Happy New Year's to you as well. So you were there for New Year's then, I guess?
For New Year's, for Christmas as well, yes. We shipped all the kids, Santa's toys, I should say, Santa's gifts for the kids. We shipped it here, and we told the kids that hopefully Santa finds us. But yeah, my son got a couple of lightsabers for Christmas. So, I should have brought it on the podcast with me.
Is it a green lightsaber in honor of 2023? Not a red one, right? I hope not. We don't need any red. We didn't have any. We didn't have much red last year. We don't need to start it now. Yeah. So
it's got multiple colors.
There we go.
It's got multiple colors. It's good.
So yeah, let's kind of dive in things. We are going to talk about some New Year's resolutions in a little bit. I'm still trying to think of mine. Sonu's like, let's talk about New Year's resolutions. I'm like, oh boy, I better come up with something. So I'm still thinking about it here.
There you go.
We're going to talk about. Hey, listen, it was a great end of year rally. If you listen to this podcast, we were expecting an year end rally. Honestly, maybe it's even a little stronger than we were expecting, but it's a good problem to have. Where do we go now? And then Sonu brought up some interesting points with some of our partners just a little bit ago about early cycle versus late cycle. Believe me, there are some potential late cycle signs, but what might blow people's minds, there are a lot more early cycle signs. We'll talk about that. Then just the idea of how the average year isn't so average, depending on how much time at the end. We'll discuss that. So Sonu, I mean, it is what it is. We just had a huge end of year rally. The S&P 500 was up over 14% the last 2 months of the year. For the year, gained over 24%. NASDAQ up over 40% for the year. We can go on and on. Most people have seen a lot of these numbers. What do you think really sparked? I mean, honestly, it was even probably a bigger move in bonds if you think about it. What sparked this move into risk assets really, since late October?
I think it was just low inflation numbers. Inflation coming below. Look, it's not like everyone expected inflation to surge again, but towards the end of October 27th, right? It's interesting. One of your charts points out the fact that markets almost always bottom on October 27th, and boom, it almost played exactly to form. Not almost, it played exactly to form, right? I think last year, the equity market stocks bottomed on October 27th. It was off to the races after that. Off to the races is an understatement for actually what happened, I think. But yeah, no, low inflation numbers. And then the Fed at the December meeting, we talked about a couple of podcasts ago, acknowledging that, right? That was the important thing. Yes, it's one thing. All of us have been looking at the inflation data. You and me have been talking about it. It's like inflation's going to fall. Right. It's almost getting boring to talk about it, right? The problem is the Fed had not quite acknowledged that. They kept saying, we want to see more data. We want to see more data. Well, they've gotten it, and they acknowledge the fact that, okay, inflation's slowing, and they penciled in rate cuts for next year. And there you go. Like I said, off to the races for markets.
Well, no, absolutely. And if you listen to us, we talked for a while about just the idea of how well last year played out. It's a pre-election year, right? It's a president up for re-election. Stocks tend to gain over 20% those years. That's what happened. If you look at a pre-election year, the big gains, remember this time a year ago, everybody's saying the first half, probably won't be so good. It's the second half of the year, stocks going to do better. Well, we saw a huge rally the first half of the year. Then you had your third quarter volatility, third quarter catch your breath, then a really strong race into the year. It's amazing how things played out so well. And they did, fortunately. Now, here's something to think about, Sonu. When you gain more than 10% for the S&P 500 the last 2 months of the year, like we just did, January's been higher 5 out of the last 6 times. This goes back to 1950. The first quarter has never been lower, up 6 out of 6 times, up 6.6% on average versus the average first quarter of about 2% return. And the full next year, after a huge end of year rally, the last 2 months, the full year up 19.5% on average versus, and higher every time, versus your average year, which is up about 9%. I call this the slingshot effect. I think we talked about this honestly last year, where we had a good end of year rally in a really bad year. Let's be clear, but we did have a year end rally in the fourth quarter of the midterm year, over a year ago. Do you believe in slingshot effects? What do you think there?
Momentum, right? I feel like I am parroting myself when I say momentum begets momentum. I mean, one of your charts showed it. I just saw Sam Stovall, another friend of the podcast, email he sent this morning saying, if the S&P rises more than 20%, there's always a question, okay, is it pulling forward returns, right? Yeah. Does that mean going forward, returns are going to be negative or worse, right? Well, following years in which the market went up, the stock market went up more than 20%, the S&P 500 rose an average of 10% the next year, and 80% of the time it was up. So, like I said, momentum begets momentum, all the work you do as well.
Yeah, I haven't seen Sam's report yet, but that's good to hear that those numbers are matching what I've got, because I want to make sure I'm matching whatever Sam says. But I found, again, back to 1950, there were 19 previous years. I guess last year was the 20th. So the 19 previous times you gained 20%. What happened next? That next year is up 15 times. That's about 80% of the time, approximately, you're higher. But the average return was 10%. Median's actually 12.1. So again, those aren't wildly bullish numbers, but you know what? They're a little bit better than average. And again, they say a big year because we get to work with our Carson partners every day. We get to hear from their clients. And one of the common questions, hey, listen, we've had a heck of a run. We have. There's no doubt about it. We've had a heck of a run, but that isn't by itself a reason to be bearish, a reason to say, you know what, maybe stocks, they still can do pretty well. Next week, we'll actually talk about our outlook, how we see the world playing out of you. But listening to us, you probably have a little bit of a clue. We're still pretty optimistic. Stocks are going to do pretty good. We'll give you our exact numbers next week. But we still think, new all-time highs and a pretty solid year makes a lot of sense. And Sonu, 4 times out of those 19, stocks did gain 20%. Spoiler alert, that's not our base case right now, but if things go the right way, it's not abnormal. And here's the other thing. So we gained 24.2% on the S&P last year. That's just price return, but nonetheless, 24.2. Only once in history when you gained at least 20% was the next year higher. So let's call that 24.3%. Only once. That was 96, 97. So it'd be very common to see strong gains, maybe even, good sized double-digit returns, but to see a better year would be, very abnormal. Let's just be optimistic. What would it take to have a better year than last year? That'd be 24.3%. What would the things Sonu Varghese would need to see, you think, for that to take place? Let's be clear, it's probably not our base case, but we do think stocks are going to do pretty good this year.
Some of them we already talked about. I mean, the Fed, the economy. Let's say, for one thing, for markets to be positive, to have reasonably good returns, let's say something double digits, right? Above 10%, you don't want a recession. Now, that's not our base case, right? We don't think the economy is going to be anywhere close to a recession. Okay, then what's the next thing? I think you need a catalyst for really 20%, 25% plus returns. What could that catalyst be? Maybe Fed rate cuts, right? If now the market's already pricing in rate cuts, so I should say it's not like it won't be a huge surprise, but it's not completely 100% that we'll get 5 or 6 rate cuts this in. I was going to say next year, but 2024.
Apologies to all the listeners. We're going to keep saying next year. We really mean 2024.
Yes. No, you need a catalyst. So I think potentially, look, if inflation comes down a lot, right? Because you think rents are going to push down inflation, productivity growth means wage growth could be high and inflation lower. That could, we could get 1, or maybe we get, let's say, 6, 7 rate cuts. That could send the markets up a lot, I think.
Well said there. So those are some things, just some other things to be aware of. S&P, the time we're doing this, been up 9 weeks in a row. That's the longest weekly winning streak since 2004. So believe me, one of these weeks we're going to have a down week. It's perfectly normal. But I found, Sonu, there were 9 other times we had a 9-week win streak. 1 month later, higher 8 out of 9 times. That's kind of interesting. And a year later, higher 7 out of 9, up about 12.4% on average. Now, one of the things that I'm optimistic about, and we're optimistic about, we've been talking about for a while, is the idea of broadening out. It's not just 7 stocks. We didn't really believe that when it was taking place, but that was the what we continued to hear. But what we've started to see since, again, late October is broadening out. Small caps, mid caps, a lot of sectors. Many times with our partners, we do daily, weekly calls. Like, wow, all 11 sectors are higher. Now, it's not like all of them were up wildly, but we're starting to see a lot of participation because last year we saw tech up over 50%, communication services up, ballpark 50%. I don't think they're officially 50, but close to that. Let's just say close enough for government work. Both of those had huge rallies. And yes, that was a big chunk of why the NASDAQ 100 and some of the other areas did so well. But we're seeing broadening out. Now, Sonu, here's what I think is important. This is the Russell 2000, so small caps. When the Russell 2 in December gained 12.1%, that was one of the very best Decembers ever. And I found 19 other times the Russell 2 gained at least 10% for just one calendar month. What happened next? 6 months later, up 11.9% on average, higher 90% of the time. 1 year later, up 15.8% on average, and up about 74% of the time a year later. So that drops a little bit. But again, that's those are some pretty solid returns. One more
I like
for
those
you.
odds.
Yeah, well, they get better. You're sitting down, and they get better. We just gained 21.9% the last 2 months last year. That's November, December. I mean, talk about a 22% rally almost in 2 months. Okay. Only 3 times were higher. December 20. Well, I guess it's November and December of 20, March and April of 2009, and listen to this one, October and November of 82. Just think back to those times. Oh, those weren't the worst times to think the world's not about to end, to be optimistic. What happened next? Looking at the 10 best months ever. I'm sorry, the 10 best 2 months ever. The 2-month combos, 10 best ever. 6 months later, up 19.2% on average, higher every single time, 10 out of 10. 1 year later, up almost 27% on average, up 9 out of 10 a year later. Listen,
wow. Say that again.
I don't even know what I just said. I felt. Remember
7%.
Remember in old school when they ask Will Ferrell the really complicated question and leaves his body and he gives his perfect answer, and then they ask him, "What did you just say?" He's like, "I don't know what I just said." He left his body. I think I just felt like Will Ferrell there. Yeah, look at it again. The 10 best 2-month combos ever for the Russell 2. 6 months later, up 19% on average, never been lower. 1 year later, up 27% on average, higher 9 out of 10 times.
Wow.
So we just saw a blast of strength from small caps. Not just small caps. I mean, there's other parts of the world out there we're aware. But again, we've been overweight small caps. We've been talking about this for a while, and mid caps as well. We think into next year, small, mid caps, industrials, financials, some of these cyclical areas can take the baton. It doesn't mean tech can't do well. It doesn't mean communications can't do well. Maybe they're more market weight-ish in some of these other areas as broadening out takes place. We felt odd to be saying that back in October because everyone was looking at us like we were crazy because we still were just, seeing small caps and mid caps do poorly. Then the Fed pivot came, the inflation stuff happened, the realization there's no recession coming. Oh, by the way, small caps are historically cheap relative to large caps. Maybe all these things stacked together. It's hard to pick one reason, but all these things stacked together said, smalls can do well. And again, we'll give you our exact numbers next week, but we do think small caps are going to do a little bit better than large caps next year, mid caps as well. All right, so that was a lot. What about on the fundamental front? What on the fundamental front for small and mids could be reasons to think 2024 will smile upon them?
No, I mean, even if you just look at the S&P 500, which you think about are large caps, right? I was running these numbers, and there was talk about, it's just 7 stocks. It's just 7 stocks. Look, total return, including dividends, S&P gained 26% in 2023. The Magnificent Seven, right? So this is NVIDIA, Amazon, Meta, Apple, Microsoft, Tesla, and Google. There's always a chance I'd forget one of them, if not more. Yeah. But no, that's all 7. They contribute out of the 26%, 16 percentage points came from those 7 stocks. So it's a lot.
Yeah.
But that at 16% would have been a very good year, again, above average. But 26% was a superlative year. Why was that? That's because all the other stocks, 493 stocks, contributed 10 percentage points. That's not nothing, right? And even within your top 7, it wasn't anything like the dot-com bubble or anything. A large majority out of the 16 percentage points contribution, 9 percentage points came because of earnings growth. So a lot of this is also profit growth and recovery after a pretty bad 2022 for tech stocks, right? And then you think about, okay, what about everything else? We're just talking about small caps. One thing within small caps that's interesting is small cap industrials have been screaming.
Yep.
They've been up a lot. I mean, small caps have been dragged down by basically financial. We saw what happened at the SVB crisis, Silicon Valley Bank. There was a big drag there. And then you had a few other sectors because of interest rates, like real estate, etc., that were also big drags, right? But small cap industrials, like if you had a very cyclical part of the economy, where would you look? You'd look at the industrials and you think, okay, if those are doing well, let's look at small cap industrials. If the economy is really, struggling, if interest rates are having a massive detrimental or adverse impact on companies, small cap industrials would not be doing what they did. They're up like 25-30% or so, at least over the last year. So that was huge.
No, great point. I mean, because again, yes, the regional bank crisis, there's a lot of regional banks and small caps that put a lid on. I know biotech also, biotech small caps did poorly, and those kind of masked what were some gains. I mean, big gains. You mentioned industrials, and also small cap healthcare did well. So small cap consumer discretionary did well. There were some parts of small caps that did really well. You'd never know it because the overall indices was weak. But again, that's why you peel back the onion, and those are some great points. And now we're starting to see some broadening out for sure. And honestly, regional banks, financials, they've started to do really, really well over the past 2 months as well. One more, then probably we'll move forward. When you're down at least double digits, honestly, there's not that many years that are down double digits for the S&P, which is good for stock investors. Believe me, we've had them before. We're going to have them again, but it's fairly rare to be down 10%. But when you're down 10% one year and then up 10 at least 10 the next year, like we just saw in 22/23, what happens next? 6 times this happened. 6 times that following year, so that'd be like 2024 right now. 6 times that in the year's been higher, up 11.7% on average, so about 12%. So you kind of see in some of these numbers, these low double-digit returns. We're seeing a lot of these, hearing about a lot of these, which is comforting. And one final thing to think about, Sonu. A year ago, we talked about this. I don't have the numbers in front of me, but it's close enough for government work. When inflation's down year over year, the returns on the S&P is up like 13% on average. When inflation's up year over year from the previous year, higher than the previous year. It's up like 6%, about half that. Inflation, this is one of the things we talked about a year ago. Listen, inflation's probably, we weren't like making some wild call, and we said inflation's probably going to come back. And it sure enough did, and we avoided the recession. When you have those two, they act as major tailwinds for investors. We don't think there's going to be a recession, but I want to talk to you about inflation, then we'll move forward. Yep. Do you think inflation will still kind of trend lower this year than it was last year? Again, which history would tell us will be a tailwind for equity investors?
Yes, short answer. Right.
That's very short answer, actually. There's no such thing as a shorter answer, I don't think.
Well, look, inflation by the end of 2023, we yet to get December data, but let's talk core inflation. Headline inflation. You got energy and food. They're volatile. They've been low because energy prices have been coming down. Food prices also sort of are in disinflation. Prices aren't coming down, but the price growth has been slowing. Right. That's what we talk about when you say inflation. But core inflation will end 2023 above 3%, just over 3%. And I think it's safe to say by the end of 2024, unless we get some crazy, massive surprise, which is not likely,
right?
We're going to see core inflation closer to 2%, right? By the way, that's why the market's pricing in a lot of rate cuts, right? Much more than what the Fed is pricing in. Look, over the last 3 months, core PCE inflation, which is the Fed's preferred index, personal consumption expenditures index, that's running at 2.2% annualized pace. Last 6 months, Ryan, that's running at 1.9%. So we're already there at 2%. And going forward, used car prices, we know that's coming down. New vehicle prices are under pressure, downward pressure too.
Time out. Sorry. Yep. Just literally on CNBC. What happens after a 20% gain? There it is. We literally just talked about it. We beat CNBC to the punch. It's on the screen right now. They're showing the percentages of what happens after a 20% gain.
Are they showing your chart?
No, I don't. It says back to 1928. So who knows who did that one? Maybe they did it themselves. It's not my chart, but the numbers look about the same. So that's good to see.
Okay, that's
good. Go ahead. I butted in there. Sorry. I just thought that was funny. Yeah.
Well, we're talking about inflation. So look, the expectation is we're going to go from about 3% at the end of 2023 down to about 2%. Why? Like I said, vehicle prices, used and new vehicles, I think we'll actually see prices going down. I don't even think it's disinflation. I think it's deflation there. With the rents, it's going to be disinflation, massive disinflation coming down the pipeline, right? Especially by summer of this year. So we'll always have other components of inflation going up, but rents, even in the PC index, right? Core PC index, rents are about 17%, right? So that's a significant chunk. In core CPI, it's actually 40%.
Right.
But then, forget that, right? Look at PC, that's what the Fed follows. 70% is still a big chunk of inflation. And if that's coming down, it's going to put a lot of downward pressure on core inflation. And that's why I think not just us, the market's looking at it and saying the Fed's got to cut.
Yeah, well said there. So good discussion there of kind of, we had a huge year-end rally. We expected to see that year-end rally, and there's still some clues, some signs that, again, 2024 will still probably be a pretty good one for the economy and for the bulls. So Sonu, we'll take a little break here. We're going to kind of wrap things up with kind of early versus late cycle. Christmas movies. What I mentioned this to you, give you a little time to think about it. I would have to say my favorite Christmas movie. I like Elf. I remember seeing Elf many years ago. Will Ferrell before he was, Elf's good. And then I'll be honest here. I didn't really like Christmas Vacation before, but I did watch it. I don't know, in the last week or two. It was pretty funny. I really enjoyed the way they pulled it all together. You've never seen Christmas Vacation with the Griswolds? Oh my goodness. Yeah, Cousin Eddie and all that stuff. It's just, anyway, it's pretty funny. I mean, it's stupid. It's slapstick, but then they bring it all together and the family and, everything. So I enjoy those. Those are good ones. There's a lot of them out there. What's your favorite Christmas or holiday themed movie by chance?
I like Elf, but we just showed that to the kids. And so it was the first year all four of us watched it together. I have 7 twins. So I was having this debate. It's funny you brought it up. I was having a debate. No, it's not quite an argument. I was telling someone, maybe you should consider Rocky 4. I know you're a Stallone fan, as a Christmas movie. But no, I was kidding. Because, the fight, they're in Russia and all of that. But I don't know if it really gets to that Christmas spirit. It's a little brutal, both of them are bleeding by the end of it. So no, that's probably not a Christmas movie. It was just fun to have that debate. No, my wife and I actually sit and watch. This is maybe a little tad embarrassing, but anyway, I'll give it away. It's only between us friends, right?
Exactly.
As in everyone listening to this podcast, we watch Love Actually every Christmas. So it's just a silly, slightly idiotic tradition that we have. Christmas evening, we sit and watch after the kids are asleep. We watch Love Actually. It's nice. It's got a whole bunch of those late 90s, early 2000s actor, Hugh Grants, and all of them are in there, right? So it's fun.
I can't say I know it. I've never seen it, which leads to the final question before we get to it. Is Die Hard a Christmas movie? This is separated families. It has led to just arguments and fights. I mean, it's all over social media. I'll just give my answer. Absolutely. I think Die Hard is totally a Christmas movie. What's your take?
I mean, he was going across the country for a Christmas party, right? So
there you go.
That's fair. I mean, it's more of. I'll put it this way: it's more of a Christmas movie than Rocky 4.
Yeah, that's true. Good point. I like that Rocky 4. That's good. That's good.
Low bar there.
There you go. Yeah. So on the Facts versus Feelings podcast, we do say Die Hard's a Christmas movie. We might have just lost half our listeners, but nonetheless, we'll get into it. All right, so Sonu, we've got 10 minutes or so here. We're going to talk about early versus late cycle because, again, we've heard about late cycle. Listen, the yield curve's been inverted for a while. LEI's been negative for, I think it's 19 or 20 months in a row. M2, we've heard that argument for a while. And there are probably some other reasons to say, okay, maybe we are a little late cycle, meaning you're getting closer to a recession. But you've pointed out some really interesting work. If you take a look at, let's say, manufacturing and housing, we're actually early cycle, which I know makes a lot of people's heads explode because they're just so convinced a recession is right around the corner. Talk to me about that. Early versus late cycle. What have you found?
Yeah. So what do we mean by early cycle versus late cycle? I mean, early cycle is usually when you're coming out of a recession. What happens before a recession? The Fed raises rates, housing tanks. That's usually how the story goes, right? And then the economy follows, those Fed rate hikes into recession. Then the Fed eases interest rates, they cut. And then what's the first thing that leads the economy out of a recession? It's usually housing. Then you get some other cyclical areas like manufacturing and things like that, right? So that tends to be early cycle. And this gets to a point, actually, you were just talking about small caps, right? Small caps had a massive 2-month gain above 20%. Historically, once you have 20% gains over 2 months, the next 6 months have been, strong 100% of the time. And 12 months too, right? I think you mentioned the average return is like 27%, something crazy.
Yeah, 1 year later.
Ridiculous.
Yep.
But 3 data points in there which were interesting. One is 82, 91, and 2009. These are all after recessions, early cycle, right? Small caps led the market at that time. And boom, they were off to the races after that. Why? Because it was the economy is coming out of a recession, and then businesses are investing again. Housing's turning up. It feels like we could be, especially the Fed cuts rates, right? And I think they will cut rates. It's just a matter of how many times they'll cut this year, right? And a lot of that depends on the inflation numbers and things like that, right? But rate cuts are coming. Mortgage rates have already eased from about 8% to 6.5, 6.6%. That's going to, feed into better housing numbers once we get December and January data. And look, it's going to look like, wait a minute, we're coming out of a recession, except that we didn't have a recession, right?
Well, yes. Let me dive into that a little bit, because some people would point out, hey, listen, we did just have 2 negative quarters in a row of GDP. We did just have 3 quarters in a row of negative year-over-year earnings on the S&P 500. You could argue manufacturing hasn't been soaring by any means, and housing, by the way, took away 9 quarters in a row from GDP. So by the definition, we avoided a recession, but we had a little bit of a slowdown, I guess we could say, right?
Yeah, and what's interesting is that slowdown, the 2 negative quarters of GDP. Now it feels like, goodness, that was like 18 months ago, right?
That's true too.
That was Q1, first quarter and second quarter of 2022.
Yeah.
Right before the Fed really got into the aggressive rate hikes. They really just started digging in June of 2022. So we got 2 negative quarters, and a lot of it is because of, like, the most volatile components of GDP are exports and inventories, right? It was really because of that. Underlying demand is strong, right? If you take consumption, personal household consumption, but even business investment, the Fed rate hikes, not cuts. I'm already thinking about cuts, but rate hikes had an impact. But the biggest impact is on housing, and it always is on housing. That's what leads the economy usually into a recession. This time, because of everything else that was happening, housing didn't. It dragged on GDP growth, but GDP growth held up. I mean, over the last year, goodness, Ryan, last 5 quarters, right? You take the third quarter of 2022 through the third quarter of 2023, so 5 quarters there. The economy has grown 2.9%. That's faster, not just over the last decade, 2010 to 2019, but even 2017 to 2019, when we thought we had a relatively strongish economy, it was growing 2.7, 2.8%. Over the last 5 quarters, annualized pace, we've done better than that.
That's something I think would surprise a lot of people, because if you look at the sentiment polls and how you feeling, I mean, people, they're feeling better, no doubt about it. But again, nowhere near what you would think with an economy that's growing, honestly, a lot better than we've been seeing, inflation coming back down and those things. So just interesting. I just want to build on that again. I mean, the idea that what's the market telling us, right? What's the message of the market? Well, to me, if we were truly late cycle, we'd start to see things like utilities, staples, maybe parts of real estate, although you could argue real estate's maybe more of a cyclical play right now. But let's just say utilities and staples, more defensive areas, low beta, honestly, low beta. Some low beta ETFs, you can track this too. You'd see those areas starting to outperform, those areas starting to lead. Literally like last week, okay, staples relative to consumer discretionary made like a new low on a relative basis. We're not seeing the more defensive areas, which you would think would be leading late cycle leading. Doesn't mean it can't change, but that's what we've been seeing for a while with the other things you just talked about. It brings a certain feeling to people when you tell them, hey, maybe we're more early cycle here, and maybe we are, and again, if all these things play out, that's why, again, we think there's there's always a chance, right? Tell me there's a chance, but the odds are in favor, in our opinion, of another solid economic year of growth, led by record profits, record earnings, and we'll talk more about that next week, get into some of that stuff, but that's just kind of how we see it. Sonu, let's see here. want to do, let's see, how about New Year's resolutions? And we'll finish it up with the average year isn't so average. So what New Year's resolution do you have? Or her plural? Do you have plural resolutions? I don't know.
I usually never make these, but
Right.
this year I was thinking, like there's always some pressure to do it, right? Because everyone else is making it. You feel like, oh, maybe you don't have any goals in life if you're not doing it. There's no realm of improvement. So it almost feels like I need to do something. But no, I actually did think of one. I talked to my wife about this the other day. I was like, so I'm on my phone a lot, to a fault, as you can imagine. And I think that goes for you too. But during my goal is from, I think, what did I say? 5:45 p.m. through 8 p.m. I'm going to put my phone away in a black bag or something, not look at it. That's going to be so hard for me. Just during dinner time, spend more time with the kids, all of that.
Yeah.
Because my phone tends to be on my side, and I'm like glancing at it, and sometimes my wife has to scold me. And so anyway, that's my resolution. I'll tell you how successful or not I am at that. Right?
Well, you and I text all the time. I'm probably part of the problem texting during dinner. Like, hey, Sonu, did you see this? My bad. I'll try to do better. I'll try to do better as well. Yeah. I was thinking, I like to eat, but I think our family eats out a lot more than we should because it's just easier with kids. And it's like, okay, let's get DoorDash. And I don't mind cooking, but it is, preparation and things. I think one thing I'd like to cook more because it's easier. You can, kind of get something a little healthier and a little more planned. So maybe try to cook a little more in 2024 would be something that I want to try to do. My wife's not a real big cooker, so that kind of doesn't help the situation. But I think I want to try to cook a little bit more. So that's my New Year's resolution. All right. So final thing, we got about 2 or 3 minutes. The idea of average isn't so average. Now here's what we mean by this. Your average year for the S&P since 1950s gained 9.1%. You're higher just over about 70% of the time. That's average. But here's where it gets really interesting, Sonu. After last year's 20% plus gain, since 1950, there have been 20% gains and 21 negative years. Okay, so it's almost just as average to have a 20% gain as it is a down year. Now, here's the one you really like. If you look at all those years since 1950, only 4 times has the S&P gained between 8 and 10%. Only 4. That's 4 out of more than 70. Okay, 21 times we've gained 20%. So again, when you listen to all these market strategists and people giving their calls, average is not so average. Over the course of a long enough time frame, you might gain 9% a year, but getting there is going to be anything but average. I think it's so important for investors and listeners of this podcast is for people to realize that up 9% year, it can happen. Maybe it's going to happen this year. Who knows? But it wouldn't be normal to be there. It'd be more normal to have a bigger outsized gain, especially outsized to the upside if you can avoid a recession and inflation comes back like we talked about 10, 15 minutes ago. I know that's the one you love. You want to add anything to that before we close out the first podcast of 2024?
No, what's interesting at that is you said 4 out of 70 odd years are between 8 to 10%. And if you look at most, forecasts are hard to do, right? Let's get that. I don't mean to push back on, make fun of anyone here. Forecasts are hard to do. And it, like our friend Sam Rose says, it just gives you more than the actual forecast for what the S&P 500 will be or the number it will be at the end of 2024. It gives you a lens into their process, right? That's what it does. But most forecasts for the S&P 500 for 2024 are about between 8 and 10%, ironically enough, right? And like you just pointed out, chances are the odds of a 20% plus gain are actually higher. In fact, I bet the odds of a 10% plus gain are much higher than that. And then if you think, okay, if you want to move the odds into your favor, of course, the odds of a negative year is the same as odds of 20% plus return year. But usually, not always, more often than not, negative years happen during recessions. Now, base case is not a recession, in which case you have to think, wait a minute, maybe the odds are really good for another positive year.
No, absolutely. I think that all makes a lot of sense. And we're going to discuss that a lot more next week when we discuss the 2024 outlook for the Carson Investment Research Team. But with all of that, this again was episode 66. Welcome to 2024, very first podcast of the year for Carson's Facts versus Feelings. Again, this one was sponsored by Y Charts. So with all that, everyone, we hope everyone had a great holiday season. Hopefully you're getting back into the swing of things. Every day has felt like a Saturday or a Sunday for it feels like 2 weeks now. So we're going to get back in the groove of doing our this podcast. We've had a lot of success with this podcast. We really appreciate it. Give it a like, give it a follow. We appreciate those things. It goes a long way. And with all that, we're going to be back next week with our outlook. Take care, everyone. We'll see you then. Sonu, enjoy your final, 48 hours or 72 hours in the Sunshine State. Take care, everyone. Goodbye. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.